have to give information to the registrar of company, you have to file income tax return. So there are so many regulatory requirements for that. You need information and you need to prepare accounting looking to what is the need. Then sometimes there are many other shareholder or stakeholder with which you have to share information of the accounting, therefore you need to do it. Say for example, you need to give information to the suppliers, you need to give information to the government about cost, what is the cost of a selected product. You want to take managerial decision, therefore you need information. Now this information should actually serve the purpose, and therefore this information that we seek from the accounting must have certain quality, and that quality we will discuss the next lecture. But this information may be either quantitative or that information may be qualitative. Similarly, out of quantitative information, there may be information which is related to accounting or it may be related to non-accounting. Say for example, there are 10 employees and 7 employees has resigned. So attrition rate will be determined on the basis of quantitative information, but that information is not accounting information. As we have discussed in the definition of accounting, it does not fit to that. So information may be either quantitative or qualitative. Information may be quantitative, then there may be information which is accounting and non-accounting information. Our focus will be on accounting information. Now accounting information may be classified in more than 4 classes, but we will briefly discuss operating information. It means I have purchased on credit, I have to pay 500 rupees, therefore I have to record my operation. Similarly, I have paid 500 rupees cash and I have purchased, I have to show where I use 500 rupees. So to determine my operation, I am recording that information. So this information is related to my operating activities. Similarly, I am doing lot of transactions, and that transaction at the end of the year give me the financial status. So the second set of information that is given is financial accounting information, and this information at the end of the year or during the year we use for the managerial decisions. So that information is the management accounting decision. Whether I have to use this information for purchasing goods or not, whether I have to close unit or not, this is the information related to management accounting. Similarly, I have to pay a lot of tax. There is a long list other than income tax. We pay excise if we are manufacturer, we pay service tax if we provide services, we pay custom duty if we import, we pay value added tax if we sell within the state, we pay CST, that is the central sale tax if we pay, we sell goods outside the state, and still there are many more taxes. There is a long list of taxes one has to pay, and these taxes are required to be understood in the sense of accounting. So accounting information is generally possible to classify by these 4 different accounting information. I think we have discussed that there are 2 approaches which are possible. One is the forward approach, that is the accounting information for accountant. How the transaction took place, how it was identified, how it was recognized, how it was measured, and how it was recorded in process. It is the forward approach. It is the accountant's approach, and it emphasizes the concept and techniques involved in collecting information, processing information, summarizing and reporting information. On the other hand, the backward approach is generally used by the managers or other stakeholders, and that emphasizes what is the need of users, depends upon who are the users. So to understand accounting, there are certain basic terms that one should understand. The first term, as we have discussed, the first transaction is the capital brought by owner is the equity, and business is liable or business is responsible to the supplier to return the balance capital when it liquidates. It means owner is taking risk. If there is a return, it goes to the owner. Similarly, if there is a loss, it goes to the owner. So the equity part is